Welcome to the May installment of the Smith Family Foundation Public Policy Debate. My name is Bob Bowden. Thank you for coming if you're here live in the studio, or thanks for watching on TV. This month we're talking about the credit crisis, and it's an issue that's been all over the newspapers. It's hardly needs explaining, but I will tell you that just yesterday the National Association of Realtors said that median prices for a single-family home were down 7.7% in the first quarter compared to the year before number. That was the biggest decline in 29 years, the median price for U.S. single-family homes. Also, sales in the first quarter, the number of sale transactions, down 22% to an annualized rate of 4.95 million, which is the slowest home sales rate in a decade. This is a quarterly number, the slowest quarter in 10 years. Home sales, and a lot of people often talk about the real estate market being very regionalized, and sometimes people will come on TV and say, well, I'm just talking about this region or that. Home sales, the home sales fell in 46 of the 50 U.S. states, just to give you a sense of the breadth of this. Right now, it's been estimated that 4 million homes in the U.S., 1/9 of the homes, I'm told, are underwater. Underwater meaning that the value of the home is now lower than the amount of the mortgage that is on that home. And according to economy.com, a year from now, things are going to get worse. As the prices, go lower, then you're going to have more homes underwater because it's a function of price. And they estimate that 1/4 of the homes in the country may be underwater 1 year from now. What should we do about it? Well, a lot of people have a lot of different ideas. Barney Frank in the House has an idea to help bail out some of these owners of mortgages and the homeowners by having a deal where the federal government will, if the lender agrees to reduce the amount owed, they will back a new mortgage on the part of the lender. Also, the homeowner has to agree to take less of the profits when that home is eventually sold in the future. And this complicated arrangement that Barney Frank has said should go forward. And by the way, the Congressional Budget Office thinks only 500,000 homeowners would take this deal as proposed by Congressman Frank. Remember, 4 million homes right now are quote-unquote underwater. So if 500,000 take the deal, that's only 1/8 of the problem. Now, the White House says that they would veto this bill, and the White House and the Treasury has said it's unfair and it wouldn't work. So there are lots of ideas on lots of sides. I'll get to the guests quickly because we have 4 guests tonight, and we'll begin with opening statements, and we'll introduce them one at a time. I'll begin with James Lardner, Senior Fellow at Demos. He describes that as a progressive think and action tank. And he also is the co-author of this book, which should give you some sense of his perspective, Up to Our Eyeballs: How Shady Lenders and Failed Economic Policies Are Drowning Americans in Debt. Please welcome James Lardner.
Thank you. Yeah. Picking right up from the introduction, you will hear a lot, we will all hear a lot about this idea of a homeowner's rescue in coming weeks. And we will all hear the phrases, taxpayer-funded bailout for lenders and speculators, or words like that, on the one hand, and on the other hand, we must do something about a terrible human and economic tragedy, on the other hand. It is a terrible human and economic tragedy. The results of this subprime mortgage meltdown, which is becoming a more general mortgage meltdown, are about as bad as anyone imagined a year ago when it began. Hundreds of thousands of people have lost their homes. Hundreds of thousands of more people are headed that way, in many cases because of loans that were never clearly understood or explained. The foreclosure rate has roughly doubled in the last year. There are an estimated 20,000 foreclosures being completed every week. And that's in line with the estimates of about 2 million or more foreclosures over the next couple of years that were made by a lot of lending rights advocates and widely dismissed by the lending industry in early 2007. The surrender of so many homes, the passage of so many homes into the possession of banks and lawyers and liquidators, it will have ruinous consequences for cities, towns, neighborhoods, above and beyond the effects on the people who are ousted from their homes. Vacant houses attract looters and squatters, and there's a contagion of neglect and decay, vandalism. Everybody around suffers. People who don't have subprime mortgages, people who rent. These kind of absentee owners generally don't take very good care of properties. That's also often true of the speculators who move in next in these situations. Local governments' foreclosures mean added expenses and also diminished tax revenues. The damage is going to fall disproportionately, is already falling disproportionately on minorities who were targeted by the subprime mortgage industry. African Americans and Latinos in particular. Not only are they more likely to lose their homes, but home equity represents a bigger source of wealth for most African Americans and Latinos in this society than for the rest of us. The wider economic consequences of this have been just about as bad as anyone imagined as well. A year ago, Ben Bernanke, the Fed chairman, predicted little damage to the broader economy and financial markets. I don't think Bernanke believes that today. He's been using his, almost exhausting his powers of his office, trying to keep the capital markets going and avoid an old-fashioned financial panic. And despite those efforts, the credit markets as a whole have kind of semi-frozen. Borrowing costs are up for college students, corporations, local governments. The mortgage market itself is slowed way down and would hardly be operating at all, really, if it were not for a lot of capital from the government-sponsored entities, Fannie Mae and Freddie Mac, and even their financial soundness is doubted in some quarters. There's the effect, there are these channels through which a housing crisis like this threatens the wider economy. One is the housing industry itself, the lending industry. There are jobs in those industries. Those jobs are disappearing. It's part of why unemployment is up. Foreclosures lead to an accumulation of unsold properties, and that causes home prices to fall. Home prices are falling nationwide, they're pretty much destined to continue falling for a while. Depending on whose estimates you trust, they're down 12 or 15% since their peak, and some people expect them to fall an equivalent amount. Now, some decline in housing prices is both inevitable and possibly desirable, but there are consequences to a plunge of kind of free fall in housing prices. They're pretty awful. Household wealth erodes, consumers spend less because they can't. Their equity is gone, they can't borrow, businesses cut back, jobs disappear, and then still more people have trouble making their mortgage payments. We are facing the possibility of a mutually reinforcing downward spiral in the housing market and in the broader economy. Having said that, I don't want to say, a Great Depression is around the corner, or possibly, I don't even want to make any prediction. It may be that we don't face something as terrible as happened to Japan when its housing bubble burst in the 90s, and its economy was kind of paralyzed for a decade. I want to argue for the concept of a homeowner rescue, for what the critics call the taxpayer-funded bailout of lenders and speculators, although I don't think that's an accurate characterization at all. And I want to argue for it very strongly, but not because something apocalyptic is necessarily going to happen if we fail to act. Most of the homeowners facing foreclosure, it is generally agreed, would be all right if their current loans, which are tricky and overpriced, were turned into straightforward, reasonably priced loans, and if the loan principles were written down to reflect current market reality. So we're talking about unnecessary foreclosures, economically unnecessary foreclosures. And in a way, what the government is doing in this equation is sort of brokering a deal that could, in theory, be made by the two parties themselves, but it can't in practice for very complicated reasons, which we can get to later. The basic reason is, one that existed in the greatest foreclosure crisis we had in this country, which was in the 1930s and still exists today, or exists again today, is simply that borrowers, if they're having trouble collecting their money from a homeowner, they don't want to hear promises from that homeowner. But if they're going to make any concessions, they want to have a guaranteed payment. And homeowners are not in a position to offer a guaranteed payment now. I will just close by saying that we did face something like this before. We faced it in 1933. Franklin Roosevelt was the new president. Congress, at the Roosevelt administration's request, created an agency which bought up the old mortgages and arranged new mortgages. It could be done today, what was done 75 years ago, and the reasons for it would be the same. As Roosevelt said, the economic necessity demands it. Thank you.
Okay, we're going to sort of alternate the people who have somewhat more activist solution philosophy to less activist solution philosophy, just for your own notes if you're scoring at home. But number 2 on our speaker list, Walker Todd, research fellow and conference organizer for the American Institute for Economic Research. His credentials include 20 years' experience at the Federal Reserve Banks of both New York and Cleveland. Here from Cleveland, everyone, Walker Todd.
Thank you. It's a pleasure, as always, to come back to the coast and remind you once again that there are people who live west of the Hudson River and east of the Sierra Nevadas. Picking up on the remarks of the first speaker, I want to point out that there really are two similarly sourced but radically different in the triage, the approach to resolving the problem. There are two different kinds of housing crises in America today. There is what I call the coastal problem. The greater New York City area, the Northeast generally, has part of that problem. South Florida has it particularly bad. Some of the Sun Belt locales like Arizona, Nevada, Southern California, desperately bad. In those locales, there was a speculative housing bubble over much of the last decade before the bubble burst within the last couple of years. In the heartland states, like Ohio, Michigan, and others, there never was a speculative bubble. The problem that was identified before, with the great rise of house prices, resulting in mortgages now outstanding worth a lot more than the house itself at current housing price levels. That problem never really happened in Cleveland, where I live, because there had been no run-up of the house prices in the first instance. In a typical case, let's take Sacramento, California, as a representative of the coastal problem. The story I read in the Cleveland Plain Dealer on the way out here today was that in Sacramento, house prices today are 29% below year-ago levels. Among the metropolitan areas surveyed, that was the largest single housing price decline. In Cleveland, we're about 10 to 15% below peak levels. Our peak was in 2005. So you can see, as the problem works its way through, the magnitude of the problem and the coasts is somewhat different from what you're going to confront in a town like Cleveland or Detroit. One of the stumbling blocks in Congress thus far has been this proposal that lenders, in order to receive some kind of government guarantee against the mortgages that are being rescued, lenders would have to accept, say, a 10% haircut or a reduction in value on the mortgage note as a condition of entering the program. And maybe that 10% is reduced off of the fair market value of the house today. In the coastal areas, that might be enough to cover the problem, at least in terms of setting a floor under housing prices from which over time prices could recover. In a city like Cleveland, the 10% haircut is probably all you would need to do without reduction of the original mortgage note. And that opens the door to a somewhat different kind of solution in the heartland than on the coasts. A friend of mine who lives in Reno, Nevada, another of the speculative Sunbelt climes, put it to me this way: there are two different problems, but because of the media influence and other reasons, you should assume that only coastal solutions will be imposed nationally. In Ohio, we tried to grapple with this problem starting back in December by bringing to the attention of the state authorities the possibility that the state could fund its own solution, since we would not have to necessarily ask for a reduction of principal value of the mortgage notes from the lenders as a condition of entering any kind of rescue program. The general concept, as the last speaker made the point, would be to bring along something like the old Homeowners Loan Corporation of the 1930s, or a state-level Reconstruction Finance Corporation, to be funded by state-issued bonds that would buy in the foreclosed properties or the houses threatened with foreclosure. And one of the problems we confront with the problem today is many of these mortgages have been chopped up, securitized, sold off to foreign investors. It's hard to round up a reasonable representative sample of investors, especially if they are foreign, who could agree to a reduction of principal that they are owed, even if they were inclined to do so. How do you resolve that problem? Foreign investors and others who have no interest in reducing principal, offer them a buyout at par. If the states floated their own bond issues, and the Treasury has already gone on record as saying it would endorse state-issued tax-exempt bonds for the purpose of buying properties to prevent foreclosure, we in Ohio confront a particular problem that the revenues of the state backing the plan would have to come from non-tax sourced revenues, things like lottery proceeds, highway toll receipts, and the like. Many states under their constitutions would confront similar problems. State experimentation is going to be required to get us out of this mess, I think, because agreeing on a common, uniform national solution out of Washington is going to be very difficult to achieve, and as I described earlier, would be inappropriate to apply, for example, the Ohio solution in California or the California solution in Ohio. What is the solution in a place like California? I think you have no choice there but to enforce some kind of radical reduction of the principal on the outstanding mortgages at the state level, if you can work out any kind of solution at all. In Ohio, I think it is possible, and Michigan, places like that, to work out a solution where the original lenders and the investors are covered on their original principal investment, and the state would assume some risk of loss in between, giving enough time, say 10 years, for the loans to be paid back over a time period in which housing prices could recover. Some solution like that is required, and that's what I would advocate here tonight.
Okay, just a reminder to everyone, we're going to have, after the next two opening speeches, we will have, or opening remarks, we'll then have rebuttals, 3-minute rebuttals from everyone at the table. So you may want to make notes as you listen to your fellow dais members speak. Number 3 on our list, John Taylor, President and CEO of the National Community Reinvestment Coalition. He has also served on the Consumer Advisory Council of the Federal Reserve Bank Board and also the Fannie Mae Housing Impact Division and Freddie Mac Housing Advisory Board. John Taylor.
So far, I'm looking for things to put in my rebuttal, and I haven't heard a lot, so maybe I can give some of the other speakers something to rebut here. But first off, what I've been asked to do is address what I think are the causes of the foreclosure crisis, the primary causes, and I sort of boil them down into 2 overarching reasons. First, I would call it the infectious greed and malfeasance of the financial services sector. Second, I would call it the strategic and ill-advised transformation of the mortgage lending industry accompanied by regulatory lethargy. Excuse me. Let me address the infectious greed and malfeasance by the financial services sector. Now, I know that's kind of a tough term, but I do want to say that is not my term, and I want to give credit to where credit is due, no pun intended, to what is the former Fed Reserve Chairman, Alan Greenspan. Those are the words that he called this crisis. He summarized it as being infectious greed and malfeasance by the financial services sector. And I understand he's been kicked out of the Libertarian Club, if I understood my Libertarian friends on the panel here. But those are the phrases he uses, and I think it's a good term to use in this case. Until recently, our financial services sector, when a family was seeking a mortgage, they went to a local thrift or bank, and they didn't need to be a graduate of the Wharton Business School to understand the intricacies of the mortgage lending process. The bottom line was the lender would consider their characteristics, their credit worthiness, and so on, and if they couldn't afford the loan, the lender told them so, and the lender just said no. All this changed dramatically in the mid-'90s as thrifts and banks and new players on the block, large independent mortgage companies, began to compete for rates and fees and increasingly ignored the borrower's creditworthiness and used a relatively new and rare instrument called subprime loans as a tool to drive these profits. Consider that just as recently as 10 years ago, that 93% of the population that went in for mortgages got prime loans when they visited a lender. By 2006, that percentage rose to 20% of the borrowers getting subprime loans nationally. And of course, in minority neighborhoods, they developed this new phenomenon that we at NCRC call borrowing while black, in which neighborhoods of color receive 60-70% of their loans as subprime loans. And a survey conducted by Brooks and Simon recently estimated that between 55 to 61% of the population that did get these subprime loans actually had credit worthiness that qualified them to obtain a prime loan. So the subprime loan, once relatively rare and not too long ago in our history, and frankly when it was used was marginally more expensive, became a license to steal, and everybody got into the act. Appraisers, influenced by brokers and lenders, and make no doubt about how rampant that problem was. According to October research, appraisers 95% of the time were influenced by the broker or lender to alter their appraisal on a home mortgage. Consider the impact of that as housing prices are going down, and you're not really starting with a real value to begin with. Excessive loan fees, high penalties, prepayment penalties, high interest rates, option payment arms, 228s, 327s with reset rates that would put people in positions where they couldn't afford their loans in a very short period of time, high LTVs, and then the layering of multiple portions of those types of risk assessments, along with second mortgages and second liens. So the second most significant cause for the foreclosure crisis, as I mentioned, is the strategic and ill-advised transformation of the mortgage lending industry accompanied by regulatory lethargy. Am I saying that word right?
Lethargy.
Lethargy. I knew I was saying it wrong. Thank you. In any event, Prior to the mid-'80s, the housing finance system was such that banks and thrifts held mortgages until maturity, and as a result, their exposure to default and liquidity risks were prominent in their thinking. Commercial banks, with eyes on this consumer market, changed this safe and proven system of housing finance into a securities-based system of housing finance. Relationship lending became unnecessary, and a new breed of mortgage lender emerged. Non-banks, non-thrifts were invited into the mix. This resulted in separating loan making from loan risk-taking. Coinciding with this transformation of the mortgage industry origination process was the expansion of this use of the subprime loans under the guise of being risk-based lending. With subprime lending, where you held nothing in portfolio, fees became the name of the game. Wall Street was buying, bond agencies were given their quality assurance, often AAA ratings, and investors, largely unaware of the unsavory and true risk nature of these products, were flooding the market with their investments. As people began to warn the regulatory agencies of the true nature and questionable safety and soundness of these loans, and we at NCRC did this as early as 2001, 2002, the regulatory agencies continued to ignore these warnings. Consider that in 2004, 2006, when the market had already begun to bottom out, and numerous media sources had detailed the precarious nature of these subprime products, this segment of the industry grew exponentially. In 2001 to 2003, there was about 8.4% of the $9 trillion in mortgage loans then done were subprime. 2004, that figure from 8% of all the $9 trillion in loans had jumped up to 20% of all the loans that were done. Again, this system continued to be driven by a pipeline built by Wall Street to the loan officer or broker. At this point, frankly, 75% of all the subprime loans were being done by non-bank institutions. More importantly, the role of Wall Street securitizers was never more clear, where in 2001 and 2003, nearly 55% of subprime originations which securitized the Wall Street, that figure ballooned to 80% by 2004 and 2006. The transformation was complete. Portfolio lending was a thing of the past. State pension funds, European, Asian investors, others now held the risk for these loans, and all came crashing down like a giant Ponzi scheme when the inevitable occurred. Housing prices began to drop. In summation, I will say that it is predicted that you've heard some figures about another 2.5 million foreclosures, and if you thought 2007 was a bad year, this first quarter we just saw a 65% increase in the foreclosures. Credit Suisse is predicting that we haven't even begun to feel the impact of the payment option arms, which are going to be nearly as much as the subprime loans that we've seen. So I don't have time to talk about some of the solutions, but maybe I'll get a chance to do that during the rebuttal. Thank you very much.
All right, fourth on the list, last but not least, George Selgin, professor of economics at the Terry College of Business at the University of Georgia. His principal research areas are monetary and banking theory, monetary history, and Dr. Selgin is known also for his research in the private issuance of coinage, which I'm told was back in 18th century England. Everyone, George Selgin.
Thanks, Bob. Well, John, you did it. You've given me something to argue with.
Good.
Unlike some of the other speakers, I'm not here to offer any clever solutions for resolving the present crisis. I don't have any. But I do have an argument as to how we might have avoided the crisis in the first place and how we might avoid similar crises in the future. My position begins by considering some of the culprits usually identified for causing the subprime mortgage crisis. Blame is usually placed on dishonest brokers, rapacious finance companies, or incompetent, or to use John Taylor's term, lethargic regulatory authorities. And I'm not saying that they shouldn't be blamed. They all deserve some blame. But merely pointing fingers at those groups doesn't really get to the bottom of the problem. And the reason it doesn't is because it can't explain why the crisis happened in the early part of this century and not at some other time. Was there more dishonesty among brokers? Did finance companies get more rapacious all of a sudden for some reason? Did regulators get more lethargic? And if those things happened, why did they happen then and not at some other time? Something happened to the environment, to the financial environment in the early part of this century. Some new developments must have happened to cause the subprime mortgage boom and bust to take place when it did. Now, there are a couple factors that one can identify, actually three. Two of them, which I'm not going to emphasize, and I'll explain why later on, but they are important, are the deregulation of interest rates that began in the 1980s that allowed interest rates to rise above limits previously in force, and that, of course, opened the gates in a way to lending to high-risk borrowers in mortgage markets and elsewhere. The second development was the securitization of mortgages that allowed them to be sold by their originators to finance companies, and that, of course, created a much broader market. And it also caused a separation between the originators of mortgages and the persons ultimately holding them, and that, of course, raises important issues and problems. But I think the most important factor, environmental factor, that should be emphasized as the cause of the outbreak of the ballooning of subprime mortgage lending at the beginning of the 2000s was the presence of easy money. Now, the most common way of gauging how easy money is in the economy, or one common way of doing it, is by looking at the so-called federal funds rate. That's the rate at which banks borrow reserves from each other on the short term, overnight, actually. The lower that rate is, generally speaking, the easier money is. That is, the more abundant credit is in the economy. Now, you can't read this chart from where I'm sitting, but you can see how the federal funds rate has evolved. The chart begins in 1990 and ends in about 2006. Would anyone like to guess when the subprime mortgage bubble was expanding? The answer is when the rates were at record low levels. And that occurs right here. That's from roughly the end of 2000 through the middle of 2004. Then the rates start very slowly going up. How did the rates get so low? They went down from 6.5% at the end of 2000 to just 1% in the middle of 2003, where they stayed for a full year, and then they only very gradually came up. Fundamental responsibility for those record low rates and the record abundance of credit belongs to the Federal Reserve. The Federal Reserve policies drove the federal funds rate to record low levels. Now, it's because the Fed was creating credit through open market operations, that is, buying bonds in the New York market and providing more reserves to banks in that market, that credit was so abundant. And it was and fundamentally, the reason why credit was abused on such a vast scale in the beginning of the 2000s was because there were such vast amounts of credit available to be abused. And that's the Federal Reserve's fault. Now, the Fed didn't do this for no reason. It had a reason, but it wasn't a very good reason. The reason was a policy of trying to make sure that when asset markets collapse, they collapse with a so-called soft landing. It's the same policy that's being implemented right now, so watch out. In that case, in 2000, the policy was implemented in response to the dot-com crash. The Fed has another policy, which is not to worry about asset markets as they're blowing up. That's not the Fed's problem. So has said Alan Greenspan, so says Ben Bernanke. So when the asset markets collapse, then the Fed steps in with easy money. The idea is to provide liquidity to make for a soft landing, kind of like what's happened recently with Treasury policy. You get your rebate checks, so we'll all feel the blow from the recent declining asset markets a little less sharply. The problem is, it's one thing to do that with Treasury rebates, another to do it with monetary policy. When monetary policy gets easy, it distorts prices in the market. It doesn't distribute liquidity in a more or less even fashion like Treasury rebate checks do. It injects it into the New York market, which lowers interest rates, not just the federal funds rate, but rates on mortgages and other kinds of assets. And the Fed has no control on where the liquidity goes. Long-term investments especially are affected, and mortgage lending can be particularly influenced by Fed easy money policy. So this was an unintended consequence of an attempt to engineer a soft landing from the dot-com boom. That unintended consequence was part of a package of unintended consequences. Credit was easy, so mortgage lending exploded, but one way you get rid of lots of credit in the mortgage market is you lower rates to get more borrowers, but when that doesn't quite sop up the extra credit, why, you lower credit lending standards. And one way to do that is shift into some subprime mortgage lending. John mentioned how in 2006, subprime mortgages were over 20% of total mortgage lending. But in 2001, they were less than 9%. What's happening in between? There's more credit to lend. Okay, I've got only time to conclude with my suggestion for how to prevent this sort of thing from happening again. Well, the answer is to not do exactly what Bernanke's doing now. He's trying to engineer another soft landing. You see, they don't see that they caused the boom. They only see themselves, the Fed, as softening the bust. But they create the boom that leads to a bust that then they think requires softening by trying to make the last bust soft. So the answer is monetary policy has to be geared to its old-fashioned goal of preventing inflation and deflation. But as far as soft landings are concerned, they ought to cut it out. Thank you.
So, where did you disagree with me?
I'd like to talk about the two reasons that George mentioned that he wasn't going to go into. One was deregulation, and the other, I think, was securitization. And the deregulation isn't an obvious explanation for why this happened when it did, because many of the key steps in the deregulation process go back to like 1980 or so. But I think, nevertheless, it's a pretty big part of the story. The human nature did not change in the last 10 years. Neither the rapaciousness or the potential rapaciousness of lenders and financiers, nor the gullibility or rapaciousness of homeowners has changed in the last 10 years. That's not why. The mortgage lending industry changed radically. And deregulation doesn't always work its effects immediately. The savings and loan crisis caused a whole lot of institutions that used to be important to giving out home equity loans to kind of vanish. And then in the 90s, there arose this new beast, the non-bank lender. And the non-bank lender did two things. One was to alter the nature of the product itself. These loans have a lot of hidden fees, and a lot of things were charged for that were never charged for before, a lot of contingency fees, and of course, the most basic thing, the reset, the payment hike, the sharp payment hike that is built into all these loans, most of which start off with an artificially low teaser rate, which many borrowers never understood. So they were rigged to become more expensive. And these unusually complicated and tricky financial products were sold to, on the whole, financially unsophisticated people. There really is no good reason for complicated products to be sold, especially to financially unsophisticated people. There's a bad reason, and the bad reason is because they're likely to go for loans that are more expensive than they realize, more expensive than they can afford. But then you ask yourself, why would the lending industry want to issue loans that might not have a high probability of being repaid, and you get to securitization. The system we have today, and that the non-bank lenders with their Wall Street partners who securitized these loans created is a system in which none of the original parties to making the loans is on the hook if the loan goes bad. The broker is not. The broker gets a commission up front. The lending company is not, because the loan has been sold and securitized and passed along. Even the Wall Street investment banks, if they play their cards right, are not on the hook, because they too can pass the securities along, and they've been paid for their securities packaging services. Only a far-off investor, who's been mentioned earlier, and the homeowner, those are the two people who are on the hook. And we allowed this system to be created in which people had no kind of incentive to care about whether the loan was ultimately repaid. So that's another narrative.
And that was, in fact, the Cleveland narrative. The mortgage lending industry in Cleveland changed radically in the fall of 2004. Between that date and the spring of 2005, a new form of lending showed up in minority neighborhoods on the east side of Cleveland that had never been seen there before, and was brought in largely by California, Arizona, and Nevada-based institutions that had suddenly discovered mining the heartland could be profitable. In thinking about solutions for the mortgage crisis, I think you need to think about doing a little triage again, a concept I mentioned before, the same kind of triage a medical worker would do on the battlefield. Some are wounded so badly they cannot be saved, put them over there in the corner. Some can be saved with a little bit of rehabilitative work, and others are going to walk out of here under their own steam, so we ignore them and work on those in the middle, okay? In thinking about possible solutions going forward, you have to think about state versus federal solutions versus none at all. A lot of libertarians believe that the right answer is none at all. Let the market rock along as it is. And indeed, conceptually, that might be a nice solution. The bad news is it'll take at least 10 years to work its way through. The problem is that bad in extended and extensive locales throughout the country. State versus federal solution. I think Congress and the White House are so divided and will remain so divided even if, for example, Barack Obama becomes President of the United States. Certainly they'll be divided if McCain wins, because it is unlikely that anything other than a Democratic Congress will be in place next year. So count on no federal solutions. State solutions are where you need to think about this, and triage within the states who can be saved, who has to be discarded. The Fed, meanwhile, has embarked on a policy of giving away its balance sheet to the investment banks and the commercial banks. The Fed held about $867 billion worth of Treasury securities. They have already given away $425 billion of them just in the last 7 or 8 months. Where is the equity kicker for the taxpayer in all of that? You're not going to see anything back from that, I think, other than a little bit of interest payment. But people are asking for equity kickers from the homeowners under the Frank and Dodd plan, aren't they? So you need to think about what is the Fed doing, picking up on George's general idea, which I think is correct. If solutions are to be followed at either the lending end, the bank end, or the homeowner end, get the Fed out of it. It is totally the inappropriate entity to be performing this duty. In the 30s, they chartered a separately politically accountable body that was on the fiscal side of government, not the monetary side. Treasury or Department of Commerce would be responsible for the entity, not the Fed. If you don't like what Alan Greenspan or Ben Bernanke are doing, whom do you vote for or against? At least if it's a Treasury, you'll know whom to vote for or against.
Well, Well, I was waiting for George when he got up to actually disagree with me, and I was looking for the disagreement, and I didn't see it. So let me disagree with something he said. Because the Fed makes funds available, and I understand the point, doesn't mean that we should be able to have the kind of predatory lending practices and the malfeasant lending practices that occurred. And actually, the Fed has oversight over that. So while they're making this money available, what they didn't do is enforce or establish rules for unfair and deceptive lending practices, which they have the authority to do it actually for the entire industry. They didn't do that. So money available or not, the failure of the regulatory agencies to step in and use the powers they had, including safety and soundness issues, which got raised as more of this junk kind of mortgages began to pile up in institutions, they simply were inactive. In fact, the market actually moved a lot faster than they did, and they're still debating what kind of rules and regulations they ought to have in place relative to unfair and deceptive practices. With that in mind, I find it absolutely appalling that we're going through this situation now where we have, it's now predicted 2.2 million foreclosures in the next year and a half, and we've already had, depending on the different statistics you listen to, somewhere near 1 million or 1.2 million, and perhaps another 1 million or 1.2 million after that, that much of this can be looked at and pointed to the practices that were, for the most part, as long as there wasn't fraud and as long as there was disclosure by a lot of these lenders, were legal practices. They're still legal. And it appalls me. I find it incredulous that we still do not have a United States Congress that has been willing to pass a law that outlaws these practices. And when states try to do it, they step in and fight the states in court and fight them from using their state laws to prohibit these kind of activities. It's unbelievable. What has to occur before we see the kind of action and leadership on a federal level? It couldn't possibly have been 2 minutes already. Am I getting short shrift here as the community? Well, let me just say, Adam Smith, arguably the single most important economist that we've had in our history, argued that the essential ingredient for a successful economy is a free market. But he also argued that the need for rule of law was critical for that. And that meant that unfair and deceptive practices were not allowed to live in concert with the free market. And that's what we've had. It's been able to live in concert. And we haven't had the kind of legislative leadership or regulatory leadership that addresses that. And unless and until we do, we will be continuing to have this problem because it is about making profit. It is about greed and malfeasance. And unless we protect the consumer while we're also protecting the liberty of the market to be successful and persevere, we simply won't have the outcome that we want. Thank you very much.
Well, I don't disagree with John about that much. It's just a matter of emphasis and noting that merely looking for the perpetrators of these, the people who are responsible for these dishonest loans, isn't getting to one of the important roots of the problem. I'm for putting all the shysters in jail if you can identify them, but to, for example, hope that the Fed will use its oversight to prevent them from doing what they've been doing, while at the same time it's more or less handing them funds to abuse, seems to me to be rather futile. And similarly, for other suggested reforms, there have been people who have said, well, we couldn't have had this abuse if we didn't have deregulation of interest rates. But the deregulation of interest rates that began in the 80s is itself something potentially very beneficial because it allows access to funds to people who are. We don't want high-risk borrowers necessarily to not be able to borrow, and we prevent that if we cap interest rates. Securitization broadens credit markets and allows credit to be available much more efficiently, which is not just a way of saying it's good for business. It means there's credit available at lower real costs for borrowers, which is a consumer, a desirable thing from the point of view of the consumer. People have said we should abolish adjustable rate mortgages, but what will we do if we have Fed-engineered inflation and can't have such mortgages? So getting rid of these things, that is securitization and adjustable rate mortgages, that's throwing out the baby with the bathwater. What we want is to get rid of the bathwater, which is the shysters, but also the Federal Reserve that fuels them. Thank you.
Okay, that was great. Well, this is just a little Q&A portion that we'll have with all the panelists, and I want to start out with James Lardner and point out I didn't hear a plan from you going forward. It was mostly rear view mirror kind of stuff in terms of your analysis of where we went wrong. What is your plan? What should we do?
About regulation or about a rescue?
The crisis.
Right. There is nothing to stop us from doing what the Roosevelt administration did in the 30s, but there is something to be said politically for doing it differently. The plan that is afoot and in Congress is one that uses the Federal Housing Administration and also private lenders to engineer new mortgages for people. And it could work, in theory.
So the federal government would back new mortgages.
What's needed is somebody to come along, and this is for part of the problem. And it is true that there are different problems in different parts of the country, and there's some levels of problems. But
just a quick
the Fed
summary.
comes
I'm
along.
a guy
sorry.
with a house. I can't make my note.
Okay.
What happens?
We have an agency. We need an outside force to come along and buy up the old mortgages, offering a government guarantee. And I say government guarantee because the government is the only plausible force that can do this. And then it becomes possible to issue new mortgages to people that are both on fair terms and at a fair total principal.
And just quickly, if the government buys up all these bad mortgages, how is that fair for the people that made good mortgages and made their payments and played by the rules?
Well, you have to understand that the people who come out of this saving their homes are not going to be happy larks. They will have suffered in a number of ways. We're not going to be rewarding their behavior in a way that makes them say, oh, hey, let's go take out another irresponsible loan. There's a lot of suffering that is not going to be undone by this.
Okay, Walker, Todd, moving on to you. State of experimentation, I heard that loud and clear in your presentation, that the problems are different wherever we go. But you said if we just rely on the market to solve this problem, it'll take 10 years to work its way through? Where does that come from?
Anyone here from Texas? How long did the Dallas housing bubble decline last in the 1980s, 1990s, when it finally blew around 87? The answer is about 10 years. Many of you are from greater New York. The New York suburbs had a marvelous housing decline after 1987 and house price levels. My recollection is it was 93, 94 before house prices got back to par in greater New York. But in certain areas where they'd really overdone it, like Texas, it was 10 long years before you saw the same house price level again.
And why is it a state-by-state, you describe it as very different regionally, but what I was hearing from Dr. Selgin is that the Fed funds issue, that's a national number that gets set. Why did that not affect the Midwest?
In our case, there was just no housing speculative bubble that ran into the bust around 2006, 2007. We did not have the bubble. On the coasts, you did have the bubble, and that's what made this thing so much worse. Think about my Sacramento example. Arguably, house prices ran up 40 to 50% above a long-term sustainable level, and mortgage loans were booked at that high inflated level. Now, nobody wants to take a 50% hit. That's the problem on going forward with the solution there.
Mr. Taylor, you were focusing on unfair and deceptive practices, and I guess I want to pose the question that was posed before by the professor, which is, did those just start? Did people suddenly become rapacious? Suddenly become greedy in the financial, greed in the financial services industry? I'm going to faint from, there's gambling in Casablanca.
I think it's one of the points I made earlier, Bob. When a person walked into a loan office, that loan officer would look at you and they'd look you up and down and they'd go, am I ever going to see this money again? Is this person going to pay this loan back? And that thinking was because the loan officer put it in the portfolio of the bank and collected that loan payment every month, and they had a dog in the hunt. They might have had a horse in the hunt, but you know, when we changed that system of finance to being, you know, all the bank was concerned about is getting fees, and as many fees as possible, you changed the paradigm, and that's why you had all these exotic kind of products, subprime as well as predatory, as well as even prime products that are now, we're going to find are problematic, these payment option arms, interest only, that were driven by fees. They even had rewards for a lot of these loan officers and brokers that if you talked someone into a more expensive loan or into a prepayment penalty or a higher interest, you as a loan officer got rewarded. It's called yield spread premium.
Sure. You know, I remember, though, in the 90s, there were times when lenders were criticized for what was called redlining, for not
Sure.
lending to poor
Yep.
areas. They were supposedly evil for redlining. They were evil for not lending to the people without a lot of
Yes.
money. Now they're evil because they did lend to people
Yeah.
without a lot of money. Explain that.
Yeah, sure. I mean, that's not a problem because what we were looking for is for the lending industry to in fact pay attention to these areas that they were redlining. So they were actually saying, they had a policy. You understand, redlining is not a term invented by community activists. It was invented by lenders. They'd take a map and they'd draw a red line around a neighborhood, usually black or brown residents, and they would say, don't make any loans here. So it didn't matter the creditworthiness of the borrower. That's what redlining was. That's why we had the Community
It was
Reinvestment Act.
geographic rather than a
Yes,
case-by-case.
yes, and
Okay.
it was a way of getting around the fair lending laws, which were racially based, and they would say, well, we're not discriminating on the basis of race, we're discriminating on the basis of this neighborhood, we don't think it's viable, and so we're not gonna do it. So that argument still holds, but to shift from, you know, what was just 10 years ago, most people getting prime loans, to now minority neighborhoods getting 60, 70% subprime with layered risk and things that were really designed
Right.
to not keep those people in those homes for a long period.
The pendulum
only designed
swung
to
too
get-
far the other way.
Absolutely.
All right, Professor Selgin, my question to you is, you said that the problem with the Fed funds way of injecting stimulus into the economy to create a soft landing is it doesn't do it evenly. The rebate checks supposedly do it evenly. How is it uneven to help sort of all homeowners in America, or all at least people buying homes in America? That seems like a fairly broad population group.
Well, what's uneven, the sense in which it's uneven is in its influence on spending patterns and prices. So if you give everybody a rebate check all around the country, they might increase their purchases of many things, and there wouldn't be any tendency for any particular asset prices to go up, for example. But when the Fed creates new money and puts it in the New York reserve market and interest rates are driven down, that causes asset prices to go up, including mortgages. And you have a distortion because it's unsustainable. So you create a boom in the asset prices, in this case houses, but then eventually the money does spread out. That's the problem, because then prices generally rise, including costs, and interest rates go back up and the bubble bursts.
Time flies when you're having fun and when you have four guests. Please thank our guests tonight, James Lardner, George Selgin, John Taylor, and Walker Todd. This is the Smith Family Foundation Debate Series. My name is Bob Bowden. We'll see you next time.